23 companies. That's half of the S&P 500. Not half the names on the list, half of the money in it. And if you hold an index fund and one favorite stock on the side, there's a good chance you own that favorite twice and only counted it once. Last time we ended on a piece of homework. Look up the maximum drawdown of whatever you're holding. Not the return, the drawdown, the worst it has ever been. Say you did it. Say the number came back 70%. Here's the problem with that number on its own. It doesn't tell you anything yet. A 70% fall in something that's 2% of your money is a rounding error. The same fall in something that's half of your money is the end of your plan. So today, how much of your portfolio can one company be? Not as an opinion, as arithmetic you can do on a phone in about a minute, and then the part almost nobody checks, which is how much of that company you already own without having chosen to. Every drawdown number you'll ever read is only half a sentence. The other half is how much of your money is standing in front of it. Multiply the two, and you get the only figure that matters, what it does to the whole. Take that 70% fall. If the position is 5% of your portfolio, you lose 3.5% of everything. Annoying. You'd barely change what you're doing. 20% of your portfolio, same fall. You're down 14%. That's a bad year, but it's a year you've probably already lived through. Half your portfolio, you're down 35%. And that one is different in kind, not just in size, because of what it takes to come back. Losses and recoveries are not symmetrical, and this is the piece that catches people. Down 3.5%, you need 3.6% to get even. Down 14, you need 16. But down 35%, you need 54% just to be back where you started. Not to make money, to be level. Put a real number on it. On a $100,000 portfolio, that's $35,000 gone. And to get it back, the $65,000 you have left has to earn 54%. The hole is the same size either way. The climb out of it isn't. That's the whole idea of position sizing in one line. It isn't about being right. It's about staying in the game long enough for being right to pay. Now, almost nobody sits down and chooses to put half their money in one company. That's not how people end up concentrated. They end up concentrated by being right. Watch how fast it happens. You put 5% into something. You were careful. 5%, the size where a total loss is survivable. And then it works. Say it goes up 10 times over a decade, and the rest of your portfolio doubles in the same stretch. You never bought another share, but that 5% is now nearly 21% of your portfolio because it grew and everything else grew less. A 70% fall in it now costs you 15% of everything, 4 times the risk you originally signed up for, arrived at entirely by success. The other route is the one you didn't pick at all, shares in the company you work for, which means the thing paying your salary and the thing holding your savings are the same thing, and they fail in the same week. So position size isn't a decision you make once. It's a number that moves on its own, and only ever in one direction, towards concentration. Now, the obvious objection. Fine, but that's for speculative stuff. I own real companies, profitable ones. JP Morgan has been tracking exactly this question for 20 years. Their definition is strict. A catastrophic decline is a stock that falls 70% from its peak and does not recover. Not a bad year. A fall it never comes back from. And here's what those companies looked like at the top, right before it happened. 54% of them were profitable. 63% had low debt. Most were trading at ordinary, reasonable valuations, no bubble signal, no distress signal. And around half of them had analysts publishing price targets above where the stock already was. The single largest group of them wasn't some fringe corner of the market. It was healthcare and biotech. So the filter you were going to use, profitable, sensible balance sheet, not obviously overpriced, analysts like it, that filter was passed by the companies in the list. It isn't that the warning signs were ignored. It's that for most of them, there weren't any. And this isn't rare event territory. There's a study we mentioned last time from the Journal of Financial Economics that looked at every U.S. stock going back to 1926. 57.4% of them, more than half, did worse over their lifetime than 1-month treasury bills. Not worse than the market, worse than the safest thing you could have done with the money. all of the net wealth the stock market has ever created came from about 4% of the companies. Everything else, put together, roughly canceled out. Read those two things next to each other and you get something uncomfortable. The market goes up over time. Most of the individual pieces of it don't, which means owning the market and owning a company are not the same activity, and the second one needs a size limit that the first one doesn't. Which brings me to the part I actually wanted to show you. On the 7th of August this year, I pulled the holdings file that State Street publishes every day for the fund that tracks the S&P 500, not a summary, the file with all 505 positions and the weight of each one. Nvidia is 8.1% of it, one company, $1 in every 12. The 10 largest positions together are 38%. And to get to half of the index, half the money, you only need 23 companies. Now turn it round, because this is the number that stayed with me. Take the 250 smallest companies in the S&P 500, half the index by count, add all of them together, and you get 8.3% of the fund. 250 companies weigh the same as Nvidia on its own. So when someone says they're diversified because they hold an index fund, they're more diversified than holding one stock and much less than the word makes it sound. 500 names and more than a quarter of the money sits in 5 of them. Here's where it gets practical. Suppose you hold 90% in an S&P 500 index fund and 10% in Nvidia directly because you like the company. What's your actual exposure to Nvidia? Not 10%. The 10 you bought on purpose, plus 8.1% of the other 90, which is another 7. 17%, near enough double what you think you own. That's not a mistake anyone makes out of carelessness. It's just that the index fund doesn't show up on your statement as 500 lines. It shows up as 1, with a name that sounds like the opposite of concentration. So, the sentence worth keeping. The most you can hold of one company is the amount whose complete loss wouldn't change what you do with everything else. Not the amount you can afford to lose on paper. The amount that, if it went to 0 on a Tuesday morning, wouldn't make you sell the rest of your portfolio to feel safe again. Because that's how this actually goes wrong. The concentrated position doesn't just lose its own money. It scares you out of the money that was doing fine. And the specific thing to do this week, which takes about 5 minutes, find your single largest company exposure, the real one. Take what you hold directly, then open your index fund's holdings page, find that same company's weight, and multiply it by what you have in the fund. Add the 2. That number is your true position, and for most people it's the first time they've seen it. Then ask the question from last episode again, but about that number instead. If this fell 70%, would I still be holding everything else? This is educational content, not personalized investment advice. It never tells you what to buy. Do your own research before putting money anywhere. If this was useful, subscribing genuinely helps. The channel is new and everyone counts. And you decide what comes next. 3 on the table, 1, Amazon, every crash it has ever had, and what it actually cost to hold through them. 2, index or pick, what that 4% figure means for a normal portfolio. 3, the numbers that actually tell you something about a company, and the ones that only look like they do. You've already had half of that today. Profitable, low debt, sensible valuation, and it saved nobody. Put 1, 2, or 3 in the comments. Last time the vote picked this episode, and it'll set the order of the next ones.